Hello, rich girls. Welcome back to Old Money. I'm your host, Amber Frankusen, and you're listening to the podcast for women building the trust funds they wish they were born with. So happy you're here. Actually, I'm so happy so many of you are here. We have a lot of new rich girls in the rich girl community. So if you're new to the podcast, welcome. We love to have you. I'm so grateful that you're spreading the word. And also, a lot of you have found me from some of the other podcasts that I've been on recently, or also this random, very viral reel that I posted that brought in so many new faces into our Instagram audience and also into our listening audience. So the power of social media, it really does work in connecting you with your community. So I'm so grateful that you're here. And as you'll hear on this episode, my purpose as the leader of this podcast is to do the research, share with you what I've learned, but it's not to give financial advice, okay? So this podcast is not financial advice. If you're an OG listener, you know the rule, take a shot, but not if you're driving. Every time I disclaim that, because I think it's really important. I'm just here to be education, information, my ideas, my thoughts on things. And I struggled in answering the question that we're going to answer today because number one, it's a very personal question, but number two, it's really not my place to tell anyone what to do with their money, how they spend it, how they save it, how they invest it. It's about me sharing the information that I have here based on the research that I've done, based on all of the information. I mean, I study all the stuff that we talk about like a crazy person, like every night before going to bed. Like I'm reading, I'm learning, I'm taking notes. I've been working on this podcast episode since August. And so the reason I say this is because it's a reminder, and I think it actually dovetails really nicely into the conversation we're going to have today, which is, can you be your own financial guru? Who am I? I am just a girl who has gone through a big money journey. A lot of healing is still happening for me. I'm still learning a lot of new things. I'm still healing my relationship with money and my mindset with money all the time. And I'm just here to share that with you as I build my wealth. And hopefully you do that alongside me. But I'm not here to prescribe to anyone what to do with their money. I mean, I think about this in a lot of different ways. Even if you think about like somebody going online and telling you what their skincare system is, right? You go on TikTok, you're like, this is my skincare system. You must use these products. Look at my skin. I'm a testimonial. And depending on what your skin type is, that skincare system may or may not work for you. In fact, it might not work for you in such an extreme way that it causes irritation or sensitivity or breakouts or something even worse. And with skincare and all of these influencers online telling you how to use their skincare products, you know, there's not recourse for if you buy a product, it's $40 and it doesn't work for you and you throw it away or you give it to your friend. But in the financial world, there are laws and regulations around giving out financial advice. And that's not what this podcast is for. This podcast is about education, empowerment, new ways of thinking, new criteria, all that kind of good stuff. So if you are new here, first of all, let's do this. If you're new here, there's some like cornerstone ideas that we've talked about in the podcast, which I'll probably need to do additional episodes about them. But let me tell you where to start. Okay. Episode number one, making money your boyfriend. We talk all about building a healthy relationship with money and how if we want to be in a successful relationship with money, we have to treat it like we're dating our money. So that means tending to it, paying attention to it, taking yourself on money dates, all that kind of good stuff. Episode number 3 is also a really important episode, healing your financial fight or flight. This is really about overspending. It's about how our emotions tie into our money habits. It's more about being financially regulated and the awareness that we might be financially dysregulated or just dysregulated as a person and how that can tie into our financial habits. Episode number 5, Afford Everything You Want, is all about systems. Now, I believe that systems have saved me and that they are what's running my wealth building program, okay? All the systems I have in place, whether it's for investing or savings, it's all laid out in the Afford Everything You Want episode. Another absolute killer episode, not to brag. Number 11, Hot Girl's Guide to Investing. It's a banger. Like it's absolutely all of the random terms and things people didn't tell you about how to invest, what to do with it, all that kind of good stuff. We go through it all, and that will be a continual conversation on this podcast for sure. The next one on the list, I would say episode 18, Drowning in Credit Card Debt, all of the healing habits that you need to learn that I learned of finally getting out and breaking the cycle of being in debt all of the time. And then episode 19 goes into a couple of additional questions that people had on that episode. So other than that, I mean, you're going to find so much lifestyle, you're going to find so much reflection, so much empowerment in all of the other episodes. But I think that that's a really great place to start, especially if you're new to the podcast, because it's going to give you kind of a foundational understanding of the philosophies here. And all of those things, they're all ideas, information, and things that I would love if you applied to your life. They're things I've applied to my life that have really moved the needle in me building my net worth. And by the way, I should add in there episode 35, which is all about tracking your net worth. Huge winner. Sorry, I literally just sounded like Trump, but like, oh my gosh, so many of you have downloaded the net worth tracker. I'd love to know how that's going for you. It's available online for free, oldmoneypodcast.com/net worth. And in building our net worth, we're always looking for hacks to build it faster. Am I right? So today's question, as I said, financial advice, can we be our own financial gurus or do we need some help along the way? And I think the answer is a little bit of both. And it's going to lead us into today's letter, which is a little bit of mailbox money. So this question came in from Jordan, and I love this question so much. She writes, another topic I'm interested in is how to find a great financial advisor. Or do I really even need one? We've had one for the past few years, and I'm considering a breakup because I'm not sure we're really getting the value for our $200 a month fee. Would putting our investments in a Vanguard Target Index Fund be smarter? And that's $2,400 a year we could be saving or investing. Then maybe we could reconsider when our net worth was larger. This is my current dilemma. Jordan, this is such a good question. And I'm not kidding you when I tell you I spent months researching this because I never wanted to approach it by giving advice. I can't tell you what to do, but I'm going to give you some ideas to consider that I think are going to help everybody here kind of have a framework for how we're going to manage our money when we manage it with other people. So first and foremost, I want to talk about the specifics of your question, and then we're going to go through this framework, understanding who financial advisors are, what they do, how they get paid, if they're beneficial for you, how things would change for you over time, what to do if you're looking for one. We're going to mention it all, as Bethany Frankel would say. Okay. So on Jordan's specific question, a few things that I would ask. Number one would be, what's the value of what this person does for you? Can you use a cost benefit analysis or calculate a return on the investment in this person? So for example, you're paying them $200 a month. What are you getting for that $200 a month? Are you getting returns that are better, like $200 better a month than what you would do by investing on your own? Do you have peace of mind? Do you have somebody that you can call if you have a question? Does this person understand your financial picture, your financial goals? Are they on your team? Does having this person make you feel like you're doing something, or are they just keeping a retainer from you, selling you that they're doing something for you, and you're not really sure? I want to tell everybody out there that hires a service provider, it is okay to ask them what they do for you. What's the value? I work in a service-based business, and every single month we give all of our clients a report of what we did the previous month and how it worked. Like, we are constantly proving our value to our clients, and it's okay to ask people or tell them, hey, I have questions about this and I'm not really sure it's the best investment for me. Now, one of the things that's maybe written in between the lines right now, or right here in this letter, is it says, would putting our investments in a Vanguard Target Index Fund be smarter? Which I think is alluding to the fact that maybe this person is allocating or balancing your portfolio for you, and you're thinking maybe we should just shove it all into a Target Index Fund. Again, I can't give you financial advice. That's something that you're going to have to evaluate on your own. But if you're interested in target date funds, had a really good conversation with Ann Lester about that last week's podcast. If you haven't listened to it yet, we talk about how target dates funds automatically rebalance and reallocate your investments over time as you get closer to retirement. I love target date funds. I think they're a great investment. But what you need to look at, and again, this all comes back to a numbers game. What is the historical return on a potential target fund that you're looking at versus what has this person done for you, for your returns? And again, it might not be just as simple black and white as like, what are the numbers, but how do they make you feel? Do you have an advocate on your side? And what are your other options? So that's what I really want to get into today from a real educational standpoint, understanding who financial planners are and what they do. And there is a lot of jargon and a lot of different information out there about financial planners. But I think to start this program, I want to remind everybody that financial planners are just people too. Financial planners are not going to care more about your money than you do. Financial planners historically also do not beat the market. As your situation changes and grows, your net worth grows, you might find different periods of your life that having somebody to manage your investments be very beneficial for you. But there's a cost associated with that you really have to take into account. Now, Jordan, the one thing that I do really like about this is that you're paying a monthly fee and not a fixed percentage. That's going to be a huge point of consideration and something that would hugely impact your future returns. We're going to get into that. But first, let's start with understanding who these people are and what they do. So a financial planner, there are many different kinds, and normally we think about a person that's doing this, right? A financial planner might sell investment products. They might sell insurance products. They might also be brokers. There's just like a ton of things that they do, but there isn't any federal or state authorities that directly regulate who these people are. Basically, anyone can call themselves a financial planner and begin taking on clients, but they do have to be qualified to advise you in your financial life. So they'll overview your financial goals, your situation. They'll craft a plan for you, how to meet those goals. And they can help you do things even like pick out health insurance or how to pay off debt or how to budget, all of those things. Now, when we talk about financial planners, like from a kind of overview guideline, there's going to be different buckets of types of financial planners within that, right? However, once upon a time, I remember I was working in Encinitas. I went to lunch. I got a call on my lunch break from my ex-boyfriend. And I hadn't talked to this person in years. And I was so shocked to hear from them. And I said, hi, like, is everything okay? What's going on? And this guy told me that he had just gotten a job at a big financial institution. He'd been going through 6 weeks of an internship training program and had just passed his test to be a financial planner. And he wanted to know if I would like to make any financial planning decisions with him because he was now qualified to do so. So just really quickly, first of all, this guy's not my boyfriend anymore at the time, right? Obviously, he's not now either. But I'm like, why are you calling me? This is so fucking weird. Like, and also this guy, no offense, lovely person, not qualified to even balance a checkbook, but he's calling me, asking me for my business because he's going to help me do financial planning because he went through a 6-week course, 6 weeks. 6-week course. And now he's qualified to manage my money? I don't think so. Not to mention that career didn't last very long for that person because unfortunately they fell out of the program for other reasons. But the reality shook me. And it was from that day I thought, I don't know if financial planners are such a good idea because in all honesty, that's how a lot of them get started. You could get a job at a big bank, you could get a job at a big investment firm, and then you go through the training program and you start taking on clients of your own. And that was exactly what this guy was doing. He was calling me as a client because he would get commission, he would get a bonus, he would get whatever he would get from having me under his management. And he was basically trying to sell me to work with him so that he could get paid. So this person went into this particular career choice for the short amount of time that they did so that they can get paid. Now, there's nothing wrong with getting paid. You know, I love making money. I love for everybody to make money. But the reality is that person didn't have a background in finance. That person didn't have any business doing that. That person didn't have any business asking me for my business. So it gets into this sticky situation, right? Of like, is this person qualified or are they just looking for a payout? So I think it's really important to understand, where people come from, what their background is, and what their motivations are. Obviously, we're all motivated by making money, but there's a couple ways that you can do it in this field. So when we're looking at financial planners, some of the things that you might want to look for is somebody who's a CFP, a certified financial planner. This is different than the training program that this ex-boyfriend had gone through. This is extensive training and knowledge and a certification that basically gives consumers a little bit more confidence that the person they're working with knows what they're talking about. Because to be a CFP, you have to have a minimum of 4,000 hours of service. You have to pass an exam. They have a wide range of knowledge, including, key financial and investing topics. And they are also, and this is the important part, so listen up, they are also held to a fiduciary standard, meaning they're charged with doing what's best for their clients. Not all financial advisors are fiduciaries, okay? A fiduciary is a word that I want you to remember. It's very, very important. A fiduciary is charged to work in your best interest, helping align their recommendations with your goals. And it's especially powerful when you're paying somebody for a fee for their time where there's not commissions involved. Because this is where it gets really, really sticky in the financial planning and financial advice world, is when people are incentivized to sell you products based on the kickbacks or the commissions that they would get, meaning that they might be selling you something that's not necessarily in your best interest for your financial plan. But because the financial planner gets a reward, a commission, a payout, a whatever for selling that product, you got to keep in mind that their interests might not always be aligned with yours. But on the other side of the coin, I have to say, as consumers, it's our responsibility to do our due diligence. It's the same thing if you go to the doctor and they prescribe you a drug because they get a kickback or they get, donuts from their favorite medical rep or whatever it is. It's your responsibility as a consumer to know the medical thing that you're buying, the financial thing that you're buying, the whatever thing that you're buying. We cannot outsource our power or our responsibility on our decisions to other experts. I'm quoting right now, but you can't see me. The experts are in quotes. Okay, so you want to talk about how bad it is with the commission thing? There was a Harvard Business School study that looked at insurance agents who earned commissions, and they found that agents recommended appropriate products only 9% of the time. And the other 91% of the time, they recommended products that were drastically more expensive, but that they got a kickback on. So if your advisor takes commissions, chances are almost 100% positive that they're going to give advice that serves their best interests rather than your own. Don't get me wrong. I'm not trying to vilify financial planners here. I'm not trying to vilify anyone. And that's another reason I wanted to be thoughtful with this conversation, because I know a lot of great financial planners. I know a lot of great fiduciaries, but we also are going into this eyes wide open, right? Human behavior is what we consider with how we manage our money and how other people are going to look out for themselves and their money. So maybe if you're working with a financial planner or a fiduciary or whomever, and they're incentivized because of commissions, not only are you going to get screwed because you're going to have to, in some cases, pay the commission that they earned, but also the principal balance that you were supposed to invest in something that was better for you. Well, now you missed out on those gains. So I think, again, it's really important as consumers, we are eyes wide open on the structure of what's being sold to us and understanding that it's still our responsibility, even if we're taking advice from a so-called expert, that we be our own financial gurus. We can't outsource our lives. We cannot outsource the care for our money. No one's going to care more about your money than you do. It's okay to ask questions. It's okay to be sus. You're just being proactive, and actually you're being really responsible. So a fiduciary is a term you'll hear in business a lot. Like, as an example, when I am the CEO of my company, I have a fiduciary duty to make sure that my company stays profitable. And that means making decisions for the health of my company, not just for myself, but for the people that work for me. And when you are the CEO of a large company that has a board of directors or stockholders, you have a fiduciary duty to the company to do what's right for the company that's best for the growth of the company, the stock, all the stakeholders, et cetera. So when you talk about a fiduciary in the format of financial planning, essentially you're looking for somebody who's going to basically give you the highest standard of care under the law. Now, kind of tricky. There's not really an enforcement arm on this. You're taking people at their word, as you do with basically everything, right? So you're asking somebody, are you a fiduciary? And by the way, you should be asking that. Not all financial advisors are fiduciary. A fiduciary financial advisor is required by law. I think they take an oath or something. Actually, don't quote me on that. That could be wrong. But anyway, what I love about a fiduciary is that most of the time, a fiduciary is going to collect fixed fees. Even better, a lot of the times they work on an hourly basis. And if you, like many of the people listening to this podcast, have under $1 million in investable assets, this is a really great route to consider because you don't have to pay a percentage. So other ways that fiduciaries and financial planners get paid is they can collect commissions, or they can collect a percentage based on assets under management, AUM. So for example, if you have $1 million and it's invested with your financial planner, your CFP, your fiduciary, whatever. And that would mean you have $1 million at assets under management, and they would collect a percentage. If their percentage was 1%, you'd pay them $1,000 a year so that they would get paid for managing those assets. And what does that mean? What is the management? Could be reallocating things. It could be balancing your portfolio. They have, market news information on the economy. They might say, hey, the price of oil is doing this, and we expect this to happen in the economy. They're also more than likely probably going to make sure that you stay calm when chaos strikes. Like, I know that a lot of financial planners, their biggest thing that they had to do during COVID was to tell their clients to not freak out and to keep their assets invested and not panic sell and take all of their money out of the stock market, because then they would honestly have been screwed. Like, we all know what happened after COVID. Yeah, things definitely went down for a while and then they went right back up. And if you take your money out of the game, you miss that going right back up, right? In fact, a fiduciary or financial planner might encourage you to continue investing even when it feels very scary, which is a total pro. Like, you want somebody on your side that has this emotional disconnection from your money in a way, so that you can see the bigger game at play here. Instead of seeing your portfolio go down and saying, fuck, I don't want to lose any more of this money, you can lean on a financial planner to call and ask for help or advice, etc. And that's why I started this whole conversation, Jordan, with do you like this person? Do you have a relationship with them? Is there someone that you can call when things go sideways, when you're, planning to invest in real estate or, make big moves in the market or family planning, whatever it might be? Like, they can help you navigate that in the best way. So remember, fiduciary is a very important word. It is okay to ask people when you're interviewing people to work with, and we'll talk about where to find these people in a second. If they are a fiduciary, I think that's a must. I think people must be a fiduciary, because remember, not all financial advisors, whether they're just a regular financial advisor, they got certified through the company that hired them, or if they're a CFP, you want to ask if they're a fiduciary, because again, it takes away that wrinkle of wondering if the recommendations that they make to you, whether it's investment funds or places to move your money to, if they're influenced by their personal benefit or your own. And obviously, we want this to all be in your favor. We want these people to look out for you. Before we move into the kind of higher echelons of net worth and what people with high net worth are doing or what might be in the future for you, another thing I want to call out is a robo-advisor. And I talk a little bit about that again with Ann Lester. And in her book, Live Your Best Financial Life, she has some really good kind of bullet points outlined of what to look for in a robo-advisor. And that's obviously like AI. It's just a program, right? It's a financial advisor that basically automates your investing process, building an investment portfolio for you. So you basically fill out a quiz, so to speak. You tell them your age, when you want to retire, how much money you have invested right now, et cetera, et cetera. And it'll perform an evaluation for you and make a recommendation. And the reason this is a viable option is because they're very low cost. They're often around 0.25% annually, or like $25 for every $10,000 you have invested. Because the thing is, guys, again, remember, we're not just out here picking stocks, like listening to, I don't know, Jim Cramer on CNBC. Please don't listen to him. In fact, there's a whole index fund set up to track how badly his recommendations are. Okay. Like, it's pretty incredible. Sorry, Jim Cramer. My point is that human advisors, the human touch is going to cost you more, obviously, but a robo-advisor can do things like tax loss harvesting. They can do things like portfolio rebalancing in an automated way. So you're obviously going to pay less for the service because it's generated by AI. So the thing is, it's not going to give you very customized advice. It's not going to take into consideration any of your lifestyle things, your goals, other than just what you can input in. So just like ChatGPT, it's like what you put in is what you get out, same type of a thing. But now, Jordan, you ask a question about the future, which is like, maybe we'll reconsider when our net worth is larger. Here's something about having a large net worth. It's like a full-time job to manage money. Okay. We talked about family offices in a previous episode and how if you have a certain amount of money that you need to deploy, to make active, to do, you can hire a full team of people, attorneys, CFOs, CEOs, investment advisors, asset managers, development experts, whatever it might be, to manage your family's wealth. We know a lot of the families out there that are in the upper echelons of hundreds of thousands of dollars of money need to do this to keep their money active and growing and not, shrinking with inflation. So again, different situation, but you could also be, if you're a high net worth individual, looking at a wealth manager. And that is very similar to a financial planner. They're talking about retirement planning, insurance, investment management, but they also might manage other things like estate planning or tax planning or giving to manage like tax burdens, all that kind of stuff. They help you with managing multiple businesses. When things get complicated and you're wealthy, like probably going to need a wealth manager, somebody to help you keep everything straight. They also might like manage things like business documents and all that kind of stuff. It is a hassle, even for me with a small business, to keep everything straight, whether it's every 2 years you have to file a statement of information. And then did I pay my FTB tax to California? Which, by the way, California, if you're listening, yes, I've overpaid probably. I'm always paying my taxes, it feels like. But the reality is that they are overviewing on everything. You still might need some people to help you with some niche topics, like especially law or tax, things like that. But a wealth planner is something that you're going to need if you are building active wealth. It's kind of just how it goes. Now, again, the thing to watch out for, and we're going to get into this, are fees, because the fees become exorbitant really, really quickly. And then just another thing I wanted to call out here is a portfolio manager, which is a little bit different because they're just focused on your investments. So whereas a wealth manager is really focused on the big picture, your family, your legacy, what your kids are going to inherit, all that kind of stuff, a portfolio manager is basically selecting your investments, deciding when to sell them, deciding when to hold them, all that kind of stuff. So both of these people might be fiduciaries, they might not be, they might work on commissions, they might not be. But regardless of whomever you hire to work with you, you have to pay them for their time and their expertise. So let's get into that because it's the biggest part of the conversation. Hey girlies, I have something for you. That's right. It's a gift, something for free, just to make you feel abundant and wealthy. I put together a super chic, free to download net worth tracker. It's super cute and pretty, and it gets the job done. Listen, I've been tracking my net worth since 2016, and since then it's grown by 677%. It's insane. And listen, it's not the net worth tracker that did it, but it is my attention to my big financial goals. And seeing it all on paper has given me the laser focus that I need to get really serious about my financial journey. Keeping track of your net worth is one of the most powerful things you can do to take control of your financial life, and I want to help you do that. So this is free to download. You can get it at oldmoneypodcast.com/networth, all one word. Drop your email. It'll get sent to you immediately. You just make a copy. It's in Google Sheets, and you can plug all your numbers in to see what your net worth is today. Again, it's oldmoneypodcast.com/networth. If you have questions about how to use it, go back and listen to episode 35. It's called Tracking Your Net Worth. It's worth its weight in gold, because that's what it really is. oldmoneypodcast.com/networth, and let me know what you think. Okay, so there's 3 main ways that financial service providers can get paid: fees, fee-based, or commission-based. So you're like, what, you just said fees twice? I know, it's kind of confusing. So fee only means that they're going to charge you a flat fee, and that could be a flat fee of a percentage of the assets that they manage, or it could be like an hourly rate, or like Jordan's case, $200 a month, whatever, flat fee. The second way is fee-based, which is a mix of commissions and fees. So you're going to pay the fee, right? Whatever they say it is, the hourly rate, the monthly rate, the annual percentage rate, whatever. But then you're also going to pay commissions on top of that. And then just purely commission-based structure is when the financial advisor makes commissions based on the financial products they sell you. Just a little reminder from the Harvard Business Review study: commissions are going to incentivize people to make the decisions that are best for them, not necessarily what's the best for you. So what does this cost? Like, real deal, what does it cost? Well, fees for a financial advisor can range anywhere from 0.5% to 1% to as high as 5%. The rates that they set are obviously going to be based on their level of expertise and experience and prestige. Also, if you're going to do a flat fee per time that you talk with them, you might be paying a couple $100 an hour to several $1,000s an hour, or maybe you're doing like a quarterly planning session with them that costs several $1,000s an hour. Again, the fees can vary. But an interesting thing that just came up for me, I mean, the business side of this is totally different because you're talking about, CPAs and enrolled agents and CFOs and fractional CFOs and all these types of things. And the reality is, if I'm running a business and I can hire a CFO for my business, I'm going to bring that person in-house so that they have full focus on me. Remember, with any of these financial advisors, all these people, you are going to be splitting their time with all the other people that they manage, right? So it's kind of an interesting thing to think about on what that amount of money would be. Like, how much would it cost you to hire somebody for a quote unquote family office that doesn't exist, right? Like, are you paying an advisor or an asset manager $10,000 a month? Well, that would be all of their time, 100% of their time spent on you. Versus, are you paying somebody that's there fractionally for you more than $10,000 a month to manage all of your stuff and everybody else's? It's just like an interesting thing I've been thinking about because it comes up in the business world a lot. So also you might have some people out there that offer their services based on a membership fee or like a retainer fee, where you just kind of pay on a monthly or quarterly basis, and then you get access to them when you need them. That's another interesting thing if you don't need so much management, but you got to make sure again that the benefit outweighs the cost, right? So you might be hearing this and you're like, wow, this is like a really big deal. And Amber's like, it costs 1%. That doesn't sound like a lot. That's a very low number. 1% of something is very small, right? Well, in this case, it actually is very impactful. And the only thing that if you haven't worked with a financial advisor before that I can relate it to is when you accidentally get yourself into a little bit of credit card debt and you're like, okay, well, I spent $500 here and $700 there and $1,000 here and $200 there, but all of a sudden your bill's like $4,000. And you're like, how did that happen? And it's from compounding interest, right? We know we earn interest on, or not earn interest, we get charged interest, on the credit card purchases that we make. And then that interest is going to grow as we add to the pile and as we continue to not pay off the credit cards, right? So when you think about how things can kind of spiral out of control like that, it's really hard to track all of the different interest charges. They lump them all together. Then you have an annual fee. All of a sudden you owe all this money on your credit card and it feels like it just spiraled out of control. The thing that I think is really interesting with fees for financial advisors is that they kind of get baked into an overview. I mean, let me make this clear. They do have to disclose the fees to you, usually in a long ass legal document that nobody ever reads through. But when you look at your portfolio over time, you're like, that's weird. I invested $1 million, but it looks like I only made 1.2 million. And who's to say at just like an overview glance, how much of the money you invested went to fees, how much of it was just bad investment choices, how much of it was the market in general? It kind of just gets bundled together and it's really hard to keep track of the fees for people. However, as I said, 1% is not a small amount. Now, I know numbers don't do well on the radio, but bear with me as we walk through a couple of these scenarios, okay? So you know that we've talked about the stock market. Let's say it returns 8% on average every single year. If you have $100,000 and it returned 8% every year on average over 40 years, you would have $2.2 million in the bank. Again, you started with $100,000, you invested it for 40 years, 8% every year, you'd have $2.2 million in the bank. But if you had a 7% return, you'd have $1.5 million. So the difference is just 1%. The difference is $700,000 over 40 years. So if you're giving away 1% of your assets under management every single year, that can total $700,000 that you've paid a financial advisor over the course of 40 years. So again, I ask you, did you need to pay somebody $700,000 to get you 8% returns in the market every single year? Because again, there's not a lot of proof to show that financial planners or investment managers or portfolio managers or anybody out there, my ex-boyfriend who got a random job at a random bank, can outperform the market. The bummer is we're not really going to escape fees. Fees are inevitable. To play, you got to pay, right? So even if you're just going to do this on your own, you're likely going to have to pay some sort of fee. It's called an expense ratio, right? It's like the fee that you have to pay to have your funds in Vanguard, so to speak. Those expense ratios are really low, like maybe 0.15%. 0.2%, 0.25%. So that's like a quarter of a percentage. That's very different than a full percentage point. You guys know I love Ramit Sethi. I'm obsessed with him. I love his book, I Will Teach You to Be Rich. I've talked about it 100 times on the show. If you watched his show on Netflix, you saw him lose his freaking mind over that French woman who was just paying her financial advisor because she liked him a lot. And this is such an interesting thing that we do with these relationships, right? We like our financial advisor. We like this person. We're just paying them, but like we like them so much, but like, are they really giving us value? That I think is the most important thing to be asking ourselves is, are they really providing value? And the value, in my opinion, here for a financial advisor is you better be managing this stuff because I don't have time to do it as well as you could. I don't have the skill to do it as well as you could. And again, they're managing it, but like, I need to manage them, right? So again, with the numbers, Ramit makes a really good point about the same thing. Let me give you another math problem. You don't have to do any math. This is not like Amber has two financial advisors. One of them is 6'3", one of them is 6'1", one of them is blonde, one of them is brunette. The first one wants to invest money in T. Rowe Price. The second one wants to do a target date fund through Chase. Which one is going to make you more money? And it's like, okay, neither of them, because I probably dated them both in the past and they're finance bros. But with Ramit's example here, the way that he breaks it down is that 1% financial advisor fee that you're going to pay out. Remember, we talked about the difference between $2.2 million and $1.5 million is looking at the percentage change. And that is a 32% change in your lifetime returns. That's right. I said 32% of your lifetime returns is instead going into your financial advisor's pocket instead of your own. So when you say these 1% fees don't seem like a lot, and I'm not saying that you say that, I'm saying that I'm seeing a ton of conversations on Reddit where people are saying, I like the guy, he's doing an okay job, whatever. Can we do this on our own? Can we motivate on our own to save ourselves 32% of our money that we would have earned otherwise? And by the way, these are all just estimates because it's based on like an annualized rate of return average of 8%. It's over 40 years. It's based on this money, blah, blah, blah. The point is, no matter how you scratch it, you're going to be giving away a lot of money to financial advisors if you're paying them a percentage of your money to manage. Now, as you get more wealthy, this might not hurt you as much, but the difference between $700,000 in your overall retirement plan is incredibly significant if you're looking at just retiring with just enough to live, right? So I want to make sure that we all go into this eyes wide open. So what do we do? First and foremost, this is not financial advice. This is evaluating your own shit with these types of criteria, things to think about, right? If you have $1 million or more in investable assets, you're probably a good candidate to get some help. If you are under that amount, you might be able to do this on your own or with a robo-advisor or with a low-cost advisor, or more importantly, with a fee-based fiduciary who's going to charge you by the hour to educate you, to help you reach your financial goals, to help you budget, to balance your asset portfolio, all that kind of stuff. You're also really going to want somebody who's good at taxes. I have an amazing tax person who helps me with my business. I think it is the best investment that I've ever made. And I pay this person a good amount of money to help me file my taxes, to look for tax advantages, to talk overview strategy, the whole thing. But I'm also doing my own research. So I have a tax person, I have a financial person. I also have somebody that I can talk to about investments. So it takes a village. And I think that's really important. I am only working with people on a fee-based schedule. So by the hour or a monthly retainer or membership or something like that. I don't have any relationships with anybody that are based on percentage or commissions or anything like that. If you are looking for a financial planner, you should go to napfa.org. This is the National Association of Personal Financial Advisors, and you can search by location, and you should probably interview a couple of people before you just start working with the first name that you click on, because you want to make sure they have the same investment strategy or investment philosophies as you. They are people that are going to be in your business. They're going to be passing judgments maybe on the way that you spend your money, the way that you invest your money. So make sure it's somebody you feel comfortable with and somebody that has values that align with your own. Obviously, you're going to ask them questions like, are you a fiduciary? You're going to ask them what their fees are. You're going to ask them if they earn commissions on any product. You're going to ask them if they do earn commissions on product. Do you disclose that to us plainly? Will we have options? How do you work? Blah, 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 blah. So all of those things are really, really important. And as you grow in your wealth journey, you're going to come to different inflection points and you're going to come to different times in your growth where you might need to hire different people or more people. Like I mentioned, I pay a lot of people a lot of money to help me manage my money. It's what I need. I have businesses, I have things going on that I need to run appropriately, effectively, and in compliance with all of the laws. I can't figure it out on my own. I'm trying to take care of my team and my clients. So the more money you make, the more advanced strategies you might need, especially as it relates to tax reduction, legacy planning, wealth preservation, asset allocation, diversification, risk assessment, all the things, right? The one thing you can't do is outsource your responsibility, but I will say that it does take a different team to grow at different levels. Like the people that get you from zero to your first $100,000 are not going to be the same people that get you from 1 million to $10 million, more than likely. The same as in business. So again, especially as you get that $1 million mark of investable assets, especially as your situation becomes more complicated, you have multiple businesses, homes, maybe you have employee stock purchase programs or equity in companies, or you're starting to invest in different things. That is not for an entry level person to help you manage. It's somebody who's been around the block a few times, who knows the right answers to things because of their expertise and their experience. And those people are more expensive. But if you're still new to your wealth building journey and your net worth is not yet at about $1 million in investable assets, what do? Well, great job. You're listening to the Old Money podcast. I'm so happy that you're here. And I'm here to tell you my new favorite crush. Like the way that I have a crush on this man is beyond. His name is John Bogle. Unfortunately for me, he passed away January 16th, 2019 at the age of 89. But he was a very old looking man. Even though he passed away at the age of 89, he looked to be about 150 years old. But he is referred to as the godfather of passive investing. His name is John Bogle, and he was the founder of the Vanguard Group. You've heard me talk about Vanguard before. They have an investment platform, and you've probably heard me talk about a lot of their index funds, which are those exchange traded funds that we've talked about so many times. In fact, John Bogle introduced the Vanguard 500 fund, which tracks the returns of the S&P 500. You've heard me talk about this before, but if we have to go over it again, let me know. Send me a DM. I'll break it down in another podcast episode. I almost said Instagram post, but no. We're doing podcast episodes here. Anyway, this guy is just the set it and forget it king. And there is a thing that I have come across on the internet, and it is a community of people called Bogleheads. And I'm kind of obsessed with them. It's an interesting community. And the whole philosophy is, can you get wealthy with the very little effort and the very passive investing strategy? And what I've been finding in digging into this group is that a lot of these principles are things that I've picked up over time from Ramit Sethi, I Will Teach You to Be Rich, from Tony Robbins, from his investment mindset books like Unshakable. But essentially, John Bogle really has some pretty straightforward principles of investing and really straightforward rules on how to be successful in the market. I'm going to read these to you. These are from the Bogleheads wiki page, okay? So this is just me like relaying the information to you, but tell me if this doesn't sound familiar of things that we've talked about before, okay? Here's some principles of investing. I'm going to kind of run through them. The first one is dollar cost averaging. We've talked about that before. It's where you're putting in the same amount of money every single month, year, quarter, whatever. So you're always investing money. So no matter where the stock or the index fund or what mutual fund, whatever it is, no matter where it is in the market, high, low, in the middle, over time, since you're doing it every single month, you're going to sometimes buy high, sometimes buy low. Sometimes you're going to buy in the middle, but over time, it's going to average out. So by making sure that you have a system in place, you're going to always be participating in the market, buying the average, not buying high or not buying low. Also, he says, time is your friend, impulse is your enemy. Love that so much. Your emotions are not your friend when it comes to investing. You're never going to time the market. You can never time anything in finance, but you can spend time in the market. That's what matters, because when you have a runway of 40 years to work with before you want to retire, you have plenty of time to let your money work for you and compound upon itself so that you make more money with it just sitting there and being active. The third thing he says is buy right and hold tight. That just means following a plan and staying the course, right? It's just following the plan and staying the course. It's not buying, selling, being crazy. We're not trying to be day traders around here. As we know, most day traders actually lose money in the market over time. We don't have the time to be day traders. We are business owners. We are moms. We are wives. We are on vacation. We are not high cortisol queens. We are staying super low energy, super passive with our investment strategy. The other thing that he says is having realistic expectations. We know that over time, the market tends to average out to 8% returns per year. So he says, stop aiming for 10, 12, 15%. Figure out a way to save more money so you don't have to take inappropriate risks. Because if you're looking like getting close to retirement, you're like, I need the next 5 years to perform at a 15% return, you're in the wrong game. You need to have really conservative expectations and just be happy and surprised when things get better, but also be able to hedge your risk. I love this one. He says, forget the needle, buy the haystack. That means don't pick individual stocks, okay? It's a losing strategy. The haystack are these ETFs, these index funds, the things that track a big amount of companies at a time. He also says there's no escaping risk. Risk of loss must constantly be weighted against the risk of not reaching your goals, especially when you take inflation into account. So if anyone's promising you big upside while eliminating the downside, they're trying to earn a big commission. How perfect is that, Johnny? I love you so much. Perfect for this episode. Now, Johnny B also says that he believes you should not use actively managed mutual funds. Then again, remember, he's the godfather of passive investing and the index funds here. He believes it's more efficient to just invest in index funds if you believe the market overall will be efficient, which if you're investing in the United States stock market, you most likely do. The other thing is not to add unnecessary complexity. The beginning of simplicity, as he says, is the index fund. This is a quote. He says, I truly believe it is generally unnecessary to own more than 4 or 5 equity funds. Too large a number can easily result in over-diversification. Investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes. His last point on this list from, again, Bogle heads, B-O-G-L heads, don't pay for unneeded advice. This is another quote. It is the essence of simplicity for self-reliant, intelligent, informed investors to purchase shares without resorting to an intermediary, salesperson, or financial advisor. This is not financial advice from me. This is from John Bogle. But I will say that always proceed with caution. I think it's really smart to be a sensible and skeptical consumer of any product or any information. So really quickly, I just wanted to reiterate, why am I doing this? Like, I need these lessons too. I've spent the last 7 months researching this and learning all of the terms and the things and understanding the ways that the fees work. Most importantly, the money lost if you're paying these fees and what they can do to you over time, but then exploring the different ways that you can still get the support that you need, taking into consideration that as the financial status of myself or other people change, they're going to need to make different decisions. And I think that's okay too. So, I mean, in conclusion, the reason that I'm telling you this is because everything that I've told you here today, I have 15 pages of notes on this particular topic that I'm reading from my Word document right now. And yeah, I do use Word and not Google Docs. Like, don't come for me, but I'm a boomer. So let me have my thing. The thing is I've been spending so much time researching this and I'm so happy to bring it to you, but I also am not your financial guru. We are our own financial gurus. And so I hope that this shortcutting in this research, most of which has come from Charles Schwab, Bankrate, Forbes, Investopedia, SEC.gov, that's the Securities and Exchange Commission. Also from, where else is this? Oh, NerdWallet. And of course, the website of the day, NAPFA, the National Association of Personal Financial Advisors. So all of that to say, the research is out there. I hope I can shortcut it for you and get you started so that you have more confidence and context when doing your research to find what type of financial planner is right for you or which one's not right for you right now. But again, I'm not here to bag on any financial advisors or any fiduciaries that are out there that work on a commission basis. It's just that right now, that's not for me. And you have the information to decide what to do for you. So, Jordan, you asked, I'm interested in how to find a great financial advisor, or do I really need one? Such a personal question. I have no idea where you are in your wealth building journey. That's so personal for everyone, but kind of based on the information I gave, I hope today that can help you decide what type of advice or what type of support you need at this point in your journey. And if you're considering a breakup because you're not really sure you're getting the value for your $200 monthly fee, I feel you. I'd go ask some questions. I'd see what you could do. And does that mean that what this person put you into, like what investments they chose, are bad? Again, I can't make that decision for you. It's really hard to know without seeing everything at a glance, right? But does that mean you should just move everything into a target date fund? Maybe that works for you. Maybe you want to take a bogglehead approach and kind of go with a couple of different index funds and invest that way. But overall, it's going to be a super personal decision. And if this person is giving you great value for $200 a year, where you can call them when you freak out about the stock market, or you have questions about taxes, or they can help you in introducing you to the right people to help you with taxes, then maybe it's worth it. But then again, I don't know your budget. So maybe $2,400 a year is really significant to your budget and you want to allocate it somewhere else. And in that case, I say more power to you. So I hate this because the answer is, it depends. It's like the worst answer to get. But the reality is everybody's situation is so different. And that's why I wanted to take such a delicate hand with this episode and really make sure that I present all of the information in the most fair way possible. Was I unbiased? Maybe not. Maybe not totally unbiased. I mean, I did include that study from the Harvard Business Review about commissions and how 91% of people would sell you something that benefits them instead of you. That's another story. Anyway, thank you, Jordan, so much for writing in. And thank you for your patience as I've worked to get this episode together. So appreciative of you writing in and your support and everybody's support. If you have a financial question, an issue, a challenge you want to solve, send me a DM on Instagram. It's Old Money Podcast. Or if you want to be anonymous, you can go to our website, oldmoneypodcast.com. And if you go to the contact page, you can put in a fake name, a fake email. I'll never know it's from anybody specific, and give me the deets and let me see how I can help. I will do the research. I will do the work. I will help you out. That's what I'm here to do. I appreciate you so very much. If you haven't yet subscribed to the show, please do so. I appreciate you. Have a very great, wealthy week. I'll talk to you in the next one. Feeling rich? I hope so. Thank you for joining me on this episode of Old Money. If you have questions you want answered, email me at oldmoneypodcast@gmail.com or hit us up on social. We are at Old Money Podcast and I am at your service. If this episode spoke to you, inspired you, helped you, if you took a single note, it would mean the world to me if you could please just take a minute to rate and review the podcast. And if you're not doing so already, subscribe. And if you have friends who like getting rich, please share this episode with them, even if it's just on your Instagram story. And I'd love you more than Jeff Bezos loves Amazon Prime. Thank you so much, and I will talk to you on the next episode. Remember, I'm not your lawyer, I'm not your tax professional, and I'm not your financial advisor. The content presented in this podcast is intended to entertain, educate, inspire, and support listeners in their personal and professional development and does not constitute business, financial, or legal advice. In addition to that, this episode may contain paid endorsements and advertisements for products and services.